Hello everyone, in this video we're going over the non-monetary exchange basics video. So this is just going to be one page and it's going to be pretty quick. We're just talking about the basic concept of non-monetary exchange and then something called commercial substance and a couple other things. There's going to be a couple other videos, one with a formula that details basically all of the different things you would need to do in terms of solving these problems. There's a formula that I've kind of created, and then there's another video that will have basically a bunch of different examples that are going to cover, pretty comprehensive, pretty much almost anything you could see for this topic. But this first one, just the basics video, just kind of, getting familiar with the topic. Okay. So non-monetary exchange, basically it's when two companies trade non-cash assets with each other, either with little or no money involved, okay? So let's say that, as an example, we have company one and company two, and they decide to exchange pieces of equipment with each other. This would be considered non-monetary exchange, okay? So if they both have a piece of equipment and they're relatively similar pieces of equipment and they're not going to give each other any money, they're just trading these two assets with each other, that would be non-monetary exchange. Also, if you have a truck and you're trading it in for a different truck they're very similar in value and everything of that nature, then that would also be considered a non-monetary exchange. Okay, there can be a little bit of money involved. Okay, but generally speaking, once we get to a certain threshold, which we'll see at the bottom, once it becomes 25%, once the money becomes 25% of the total fair market value of the transaction, it's no longer considered to be a non-monetary exchange. So generally speaking, it's either little or no money involved, okay? Companies account for these transactions on the basis of the fair value of the asset given up or the fair value of the asset received, whichever is more clearly evident, okay? For our class, we're going to see in the problems, but basically whatever the fair value of what is given up, that's going to equal the fair value of what is received, okay? So everything that's given up should equal everything that is received. And if it doesn't, then that makes no sense economically, right? Because if I gave you $1, if you give me anything more than $1, then that makes no sense, right? Like no one is going to take that deal. Or I say, give me $5 and I'll give you $1, right? Like no one's going to take that deal, right? If I just give you $1, you're just going to give me $1 back, right? That's the only outcome that would make sense if you're a rational economic agent, okay? So then we have something called commercial substance. So again, that's why the reason I'm kind of emphasizing that is because whichever is more clearly evident, people might get freaked out. Oh, which one do I use? How am I going to know which one's more clearly evident? Well, you're going to be able to figure it out based on the examples. Like we'll see it in the problems, but don't worry about it is basically what I'm trying to say. Okay. Commercial substance. This is when a non-monetary exchange will change the timing, amount, or certainty of cash flows of the two parties involved with the exchange. So as an example, if as a result of this transaction above, both companies' future expected cash inflows increased by 20%, the transaction would have commercial substance, right? Because in that case, like your cash flows are going up by 20%. That's quite a bit, right? And so that's changing the amount of the cash flows. And who knows, it could even change the amount or the certainty of the cash flows, right, as well. But basically, when our cash flows are changing, that means that the transaction has commercial substance. It's said to be kind of a legitimate transaction in the sense that, we're going to, what happens there is that if a transaction has commercial substance, we recognize all gains as losses on the transactions, okay? Because when these transactions have commercial substance, we're not worried about people doing weird fraudulent things within accounting, okay? The reason that this whole topic became kind of basically complicated, which we're going to see in a minute, it gets pretty complicated if it doesn't have commercial substance, is because a lot of companies would do these weird transactions where they would just exchange pieces of land just to recognize like really large gains, even though nothing was actually happening from an economic transaction standpoint, right? Like if I trade a piece of land with you and you trade a piece of land with me and they're literally just sitting right next to each other, I mean, the chance that that's going to change the cash flow of my of what my operations are is very low, right? I'm probably going to have like the same cash flows, but if my fair market value is way higher than my book value, I can actually book a gain, right? I can actually increase my income. And so basically for actually nothing happening on an economic level, right? Like I'm just trading a piece of a land with literally the piece of land sitting right next to it. There's nothing different about these two pieces of land, but I can recognize I can book a gain on the accounting side and almost commit a fraud, right? And so companies did that for a while and the FASB didn't like that. So they made these commercial substance rules, these non-monetary exchange rules around commercial substance, okay? So again, if it's like a legitimate transaction, our cash flows are changing, we have commercial substance, we recognize all gains and losses. If we lack commercial substance, then the rules are much more complicated, as I was just saying. The following table details the different scenarios and the accounting treatment for when a transaction lacks commercial substance. Okay, so if we lack commercial substance, basically we're going to have to do different things based off of what scenario we're in. Okay, so we basically have 3 scenarios. The first one is a loss situation. If we incur a loss on this non-monetary exchange, then we always recognize the loss. We recognize it immediately. So those are actually pretty easy. When it becomes more difficult is when we have cash received or cash paid. So if we have cash received, okay, so that means we're getting cash, right? We're either going to recognize all or part of the gain, okay? Part or all of the gain. Those are the only 2 options, okay? So cash received, we have a little star. Let's look down. If the cash involved with the transaction is 25% or more of the total fair value of the transaction, all of the gain is recognized because these transactions are now seen as monetary exchanges by GAAP. That's kind of what I was saying before, okay? So basically, the formula used to determine the percentage of cash involved with the transaction is as follows. It's the cash received, which we call it something called boot, okay? In these type of transaction, it's kind of like just basically just accounting lingo, accounting terminology, jargon, I guess, if you will. But it's basically just the cash received divided by the total fair market value of the transaction. Okay, so if the cash received is something like $50 and the total fair market value of the transaction is 100, that means that the cash involved is 50%. So we would actually have to recognize all of the gain because, again, as it says here, if it's 25% or more, then all of the gain is recognized. Okay. However, if we receive some cash, okay, and it's a situation where it's less than 25%, we're only going to recognize part of the gain. Okay. And then how do we do that? Okay. Well, the formula to determine the amount of the partial gain is as follows. We use the same formula as above, but then we just multiply it by the total gain that we have in the transaction, okay? And so we'll see how that actually works out in the problems themselves. But, you know, if we would have recognized a gain of 10,000 on this transaction, but it's only a partial gain, then we multiply, 10%. If we had a total gain of 10,000, then we would only recognize $1,000 of gain, okay? So that's the partial gain piece. Okay, and again, this is just a quick overview just to get our feet wet. We're going to see all these different scenarios in an actual example, okay? A comprehensive example. And then we have finally cash. So we've done cash received. Now we have to do cash paid. This is a situation where we recognize all or none of the gain, okay? So again, this is a situation where once we get to 25% or more, because we have the star here, right? So once we get to 25% or more, we'll recognize all of the gain. If we do not hit 25%, we recognize none of the gain. Okay, so cash paid, it's all or none. Okay, so cash paid, you either recognize all of it if you hit the 25 or you go over it. But if you are under 25, you recognize none of it. Then on the cash received side, again, you either recognize part of it if you're under 25%, or you recognize all of the gain if you're at 25% or above. Okay, so that's basically how, that's just a quick introduction to the basics of non-monetary exchange. And all this stuff will make sense. We will go over quite a few different problems in another video. So look for that video. And that's the end of this topic.